On tonight's show, property legend Margaret Lomas of destiny.com.au shows us how to find potential high price growth properties, and she names 4 hot suburbs and towns around Australia you can have a real good look at. A&P Capital senior economist Deanna Messina says yes, the coronavirus recession is dead and buried, and get ready for a house price increase in 2021. And Paul Mialotis from M Square Capital talks about what you need to know if you lend your money to a mortgage fund. So without any further ado, let's kick off with Margaret Lomas. Well, joining me now is Margaret Lomas, and we want to talk to her about how you find high growth potential areas to invest in. Margaret, thanks for joining us.
Thank you for having me.
All right, so let's just kick off with what everybody wants. They want to invest in areas where they have high growth potential, but how does someone find that?
Well, look, it's very important for people to, first of all, understand what they're looking for in terms of growth. If you invest in any property and hang on to it for a long enough period of time, it's probably going to grow. But we also have to understand what it is that we're after. So for me, I could invest in a $1 million property and it might go up by 10% and I make $100,000. But if I could find a property for $400,000 that also went up by $100,000, then my return is far better, particularly if I bought 2 of them. So the reason I raise this is because people have a notion that buying high growth properties is all about buying in the cities, but in fact it isn't. It's about timing and understanding the markets that you're getting into and buying in markets with the greatest chance of growth in the period of time shortly after you buy it. If we consider that most people would have a window of probably around about 10 years to see growth, you really want that growth to happen in that period of time. So there's a whole range of things that you need to look for in order to find the properties most likely to begin their growth spurt not too long after you buy them. And those factors are often very reliant on each other.
Okay, so why don't you walk us through the big factors that can contribute to high potential growth?
Okay, so obviously the first one is going to be population growth, and I like to look for a population that is growing faster than the national average. Once I know an area, and it could be a suburb or a town, once I know that area has that population that's growing, the next thing that I want to do, and this is why it's really important that you validate all your data against each other, the next thing I want to do is find out in what demographic is that population growing. Because if the population's growing with people who are retired, then that isn't going to be an area that delivers good growth. Retirees tend to downsize, they tend to spend less in the and therefore they don't necessarily contribute to property price growth. The best demographic is that family demographic because we get greater tenure from those. When a family moves into an area, typically they're going to stay in that area for the period of time that their kids are in school. That's a 12-year period. So they're going to find somewhere to live where they're happy with the schools. They're going to put their children in school. No one likes to bring their kids in and out of school too often if they don't have to. And they'll tend to stay in that area. So once we have a population growing and it's growing in the right demographic, the next thing we need around all of that is the support system to keep those people in the area. Because if a population grows very well, but then we don't have the underlying services required, the amenity and the businesses doing business there for people, then they'll get to the point where they do move away because they're not getting what they need out of that area. If amenity is too hard to get, then they're going to move away. Now, I guess the last piece in this entire puzzle then, of course, is jobs. And we need employment to be pretty good. We don't want high unemployment. We don't want high unemployment in the youth sector because high youth unemployment generally means that young people move away from the area. And when they move away, they don't settle down there and have their families there. So we tend to lose population through that younger demographic. So we need good jobs provision. And for that to happen, we also then need a diversity of industry easily accessible. doesn't have to be in the area, but it has to be accessible either through really well-developed transport nodes, good roads, and good public service transport. And if you think about all of those things I've just said, they all go together. And if something's missing out of that puzzle, then it won't be a complete picture.
And so once you pick the area, are there better locations within the area? And what I'm thinking is that I think you've said to me in the past that if for example, you're buying apartments that will be lent out to younger people who work in offices and whatever, being close to a railway station is probably going to be good for that kind of potential tenant client. Is that the kind of thing we should be thinking about?
Absolutely. And see, now what you're alluding to is that whole puzzle again, because, people or property investors tend to take little pieces of what they have to do and they'll execute them without realizing that it's not so much the factors, but the concert of factors and how they interrelate. So you're now talking about, if I'm buying an apartment, then I need to make sure that it has everything it needs for the kind of people who are going to live there. But if I took a step backward before you even bought the apartment, there are things you'd have to know and work on before buying an apartment in the first place. When we talk about apartments, I often see investors choose an apartment because they see it as the cheaper option and probably the less risky buy-in option. Generally speaking, an apartment is going to cost you less than a house in most areas, although that's not always true these days. There are definitely areas where apartments are just as expensive, but we generally see them cheaper. And people think, well, I'm going to buy in that area because I hear it's a good area or the statistics are stacking up. So I'll buy an apartment first up because it feels better. It's a smaller chunk and I feel safer. It could be a big risk because you might buy an apartment in that family area and you can't get a tenant. And if you don't have good occupancy, then the next investor isn't going to want to buy it from you, and that affects the value. So we need to be careful that we're buying the kind of property that the demographics demand. And we shouldn't go seeking a property before we found an area, and that area then dictates what we buy in that area.
Yeah. At the moment, Margaret, using those filters that you've talked about, what are the standout suburbs or towns that sort of fit the bill right now?
Well, look, there's a few of them, and interestingly, Southeast Queensland is definitely coming back on our radar. It was a long time ago, and then it has come through a flat spot. But what we're seeing happening in Southeast Queensland is we're seeing a really big and very healthy manufacturing sector. So the Logan Shire alone has a $12 billion GRP, and it's increased in the last 10 years quite considerably. Much of it's firmly centred in the manufacturing area. So we have to understand that if we're going to buy there, we buy the kind of property that suits the people who we know are going to work in the manufacturing areas. So you're not going to go into the Logan Shire and find, the odd $800,000 million property and buy that just because you think I need to spend more to get more. You're going to buy the kind of property that the people who are working in demographic demand. But because it's got such a great microeconomy going on there, we've seen during COVID that Queensland on average has had a gross product decrease by about 3.1%. It's only been about 1.5% in the Logan Shire because they're not reliant on all that tourism and hospitality. It's firmly centred in manufacturing. So there's quite a few suburbs around there that are undergoing a bit of a demographic change. And Crestmead is a good example. It's formerly low socioeconomic. It also is an area that was very much a welfare area. But now we're seeing a different kind of people move into that area, buying the older homes, doing them up, and it's getting a ripple effect happening there as well. So that's one area that's really interesting. Another one is north of the Central Coast in the Wyong area, up around the Canwell area, which again has similar demographics to Crestmead, lower socioeconomic, but there's two parts of Canwell. There's the older part with the older homes and some state housing, the newer part where we're seeing homes upwards of $800,000 being built. And now, if we have a look at the income figures, previously we had a greater proportion of people in the under $33,000 a year. Now the greater proportion of people are in the 78 to 100,000 or 120,000 a year bracket. We're getting that income creep. Once we get the income creep, the brand new houses being built, we'll see those older houses bought and done up and a slightly different demographic move in. So they're the kinds of areas that I like, because we want, if we can get a cheapish property with the greater proportion of potential growth, we'll make more money overall. So I'm, blue chip means something very different to me than it would mean to someone else. Blue chip to an owner occupier means to live in, Potts Point or Vaucluse or the Northern Beaches. To me, blue chip is that property where we can very firmly identify a changing demographic, because we'll see a great period of growth happen fairly quickly as people become interested and want to get in while it's still relatively cheap, and it'll push prices and that demand really goes through the roof. Canwell only has one property available for rent at the moment. So there's a huge amount of demand coming into that area.
Any other area, Margaret?
Look, I'd probably stay away from Melbourne at the moment, if for no other reason that we're just not sure of what's going to happen there in Melbourne. But, of course, Adelaide, I always like Adelaide, and I really like the Tea Tree Gully area, because what that's targeting is the people who are going to be working in all of the new health precincts and also the new space centre there. So that kind of income bracket is now starting to move into that Tea Tree area. It's not that far out of town, and council is actually providing a lot of beautification to the area. Lots of lifestyle benefits, so open spaces, bicycle paths, nice parks and that kind of thing. And if we think about the demographic that is going to work in both health and the space centre, they're that demographic who is in probably the $100,000 to $150,000 price range. And they're going to be able to easily afford Modbury, which has an average price of about $400,000 to $450,000. But we are seeing a lot of development going on there, but it's landlocked. So there's not too much new land. We're going to see price pressure in that area. Of course, Perth does look like it's finally turning the corner. And if I was going to buy in Perth at the moment, I'd be choosing Forest Field or around that area.
Say that one more time, Margaret. You went a bit twangy then.
Sorry, I hate it when I'm twangy. If I was going to buy in Perth at the moment, which does seem to have turned the corner, I'd be buying in Forest Field. What we have there is the big airport link being developed that's really going to bringing trains out to the airport. It's bringing industry. There's a huge, big business park development taking place there. And if we have a look at the neighbouring suburbs to Forest Field, there's around about $100,000 to $150,000 price differential. So Forest Field will be the benefit of that ripple effect as the areas around it become a little bit too pricey. In Forest Field, we see middle management workers mostly. So they're on pretty good incomes, but the price range of property there is in the mid $300,000 range with an almost 6% return on your investment from a rental yield point of view. So we've got a lot of infrastructure happening there, which is going to support that entire area. And as that recovery comes into Perth, I see it very firmly happening in and around that Forest Field area.
Great stuff, Margaret. As always, fantastic insights. If people want to know more, you go to destiny.com.au.
Thank you.
Joining me now is senior economist at AMP Capital, Deanna Messina. Good to see you, Deanna.
Hello, Peter. Thanks for having me on.
Pleasure. Look, I've got to pull you into this little debate I started this morning on Switzer Daily after being on the Credlin show last night. I was quickly asked whether we're out of recession, and I said, well, in September, looks like we might be out of a technical recession. And I was just about to elaborate to the fact that as we're out of September quarter, we're probably definitely out of recession in the December quarter. But before I could even say any more, Terry McCrann started saying, no. So we're going to be having a debate, Terry and I, but I am surveying other economists to see what they think. What do you think happened in the September quarter, and what do you think is going on in the December quarter, growth-wise?
Well, this debate about whether the recession is over or not, which is kind of started by the RBA, I think, this week. I mean, it's old news, isn't it? to me it is. We had been expecting the recession to be in the first 6 months of this year. And I think that all the data that we've had, especially the retail data, the pickup in some other activity indicators, building approvals have been pretty resilient. I think it's been pretty clear that the September quarter will be positive. It's not going to be a very strong one like you're seeing in the US or in Europe, because their borders were pretty much open. People were coming in for the tourist season, and that's probably why they've had these big second or third wave outbreaks. So I think the September quarter definitely is going to be a small positive, and the December quarter should be even stronger because now Victoria has come out of the lockdown a month into the December quarter.
A lot of people thought because Victoria had all its troubles in July, that's when they locked down again, and the September quarter is July, August, September, they just figured it would be negative. But obviously the other parts of the Aussie economy are doing really well. Yeah.
I mean, so the Victorian economy is still really important, of course. It's 25% of national growth. So that detraction was probably worth about 2 or 3 percentage points. But if you look at indicators across states like Queensland, Western Australia, South Australia, activity there is pretty much back to its pre-COVID levels, not in the labour market to the same extent, but in things like credit card spending and in consumer indicators, things are looking quite solid. And New South Wales has obviously had a big recovery as well, but because New South Wales has still had COVID cases, it hasn't been as strong as in the other states. Whereas for the rest of Australia, besides New South Wales and Victoria, they're pretty much COVID-free, besides the cases that you get in the hotel, and that's just because of people coming back from overseas.
Yeah, okay. So as a consequence of this ultimately better than expected economic outlook compared to, say, 3 or 6 months ago, what is your view for house prices 2021?
We've been quite surprised at the resilience of the housing market, and I do think that the loan deferral program has had a bit to do with keeping forced selling quite low, and the other government policies that we've had as well, JobKeeper, JobSeeker, the access to superannuation. I mean, all of these things have lifted consumer incomes, and we know that consumer incomes had a windfall over the past 7 or 8 months, despite the fact that the labour market has weakened and the unemployment rate has increased. So there will be some further downward pressure on home prices once the loan deferral programs end, and they're likely to expire at the end of next year. But I don't think it's going to cause a huge amount of forced selling in the market. You may see pockets of it, but I don't think it will cause, a 20 or 30% fall in home prices. So for the next 6 to 12 months, we still think national home prices can fall by about 5% at the maximum. They've already fallen by about 4% across the nation, but particularly in Sydney and in Melbourne. And then after the middle of next year, I think that with the recovery in the economy, very low interest rates, further falls in the mortgage rates, I think home prices can actually have a bit of a bounce by 5% or so, just because the cost of borrowing has come down by such a large extent.
Yeah. Are you in the camp that the Reserve Bank will cut the cash rate on Cup Day?
We are, and we've been of that view for a while, I'd like to say, before the market started pricing it in.
Oh, you guys are brilliant. We know that. Go on.
Of course.
Yeah.
I mean, we were even of the view before COVID started, before it was even, announced that we were in a health crisis, that the RBA was going to do some form of quantitative easing because the Australian economy clearly needed the support. We were still in this situation where the unemployment rate was looking like it was trending a little bit higher. Excuse me. So I do think that the RBA will cut the cash rate on Cup Day, and that they will announce a larger scale bond purchase program like they have going on in Europe or in the US.
And it means that the term loan facility, which really provides a whole pile of money to the banks at really low interest rates, 0.1 I guess, does that ultimately mean that fixed interest rates will probably remain really low, even lower than they are now, for quite some time?
I definitely think so. The RBA has pretty much come out and said that they're not going to be increasing interest rates probably until sometime in 2023. I mean, that's just based on their forecasts of inflation and growth. And I think even in 2023, they'd still be extremely cautious in raising interest rates. So fixed rates are going to remain at these incredibly low levels, probably even below the variable rates until that period. unless, we see some very quick increase in economic growth that eats up all the spare capacity that we have at the moment.
Okay, so I guess the bottom line is that underpinning your relative optimism about growth of the economy and house prices and interest rates, there must be a belief that somewhere along the line, in the not too distant future, a vaccine will arrive and help the global economy overcome the second wave infections we're seeing now?
Well, I think that should be everyone's base case at this stage, because there are about 10 vaccine providers who are in the last phase of trials, testing on large scales of the population. And when you have that large amount of tests that are going on for vaccines, I think it's quite likely that you will see a vaccine come through by the middle of next year. I mean, it might not be available for the large proportion of the population, but for the very vulnerable groups like aged care facilities, I think that they will be available. So it is our base case. And if it doesn't come through, then I think it will be a big shock to financial markets as well.
Okay. Deanna, thanks for joining us as always.
Thank you.
This is our usual catch up with the guys from M Square Capital to see what's going on in the market right now. And last week they presented at our investment strategy day. And I thought I'd fire a few questions at Paul Miolatis, one of the founders. Hi Paul, how are you going?
Good, thank you.
To try and flesh out some of the issues that people watching the conference might have, or questions they might have about your business. Just in a nutshell, what do you do?
So we are a non-bank lender, Peter. So what we do is we match investors who have money with borrowers that have a need for finance. So the borrower will come to us with a need for finance. We will then do a credit proposal for our investors, and then the investors will choose the investments that they are interested in.
Yeah.
But the key thing for us is we are a secured lender, so we only secure our investments via first mortgage over property in the eastern seaboard.
So in a sense, you're a small version of some pretty big names out there that do exactly the same kind of thing as you, but they might have some things that they do that you won't do because you don't want to do that kind of thing.
We've got a very definitive process on what we do.
Strict, narrow.
We've got narrow. I mean, look, when you're dealing with bigger firms, you've got positives and negatives. With our sized firm, we're nimble. We pride ourselves on being able to speak to every one of our investors. We are operating under a contributory structure. So what that means, Peter, is that our investors get to choose what risk profile they want. Some of our bigger competitors, for lack of a better word, will pool their investments. So investors who may want to do construction are in that pool. Some people that don't want to do construction are in that pool. So I think it's the risk profile, whether you're big or small, you need to be careful.
So in many ways, those bigger ones can be diversified, but you can be diversified into stuff you don't want to be in because it's slightly more risky. It improves the returns if nothing goes wrong, but it can be a bit risky.
Yeah, I mean, look, we've seen pooled investments where investors are getting first mortgage money. But if you look at the PDS, you'll see that they're doing second mortgages, they're doing preferential equity, and they're going up the yield curve. With us, well, we are very narrow, as you mentioned before. You know exactly what you're getting into.
Okay. Identify who your customers are and where the money. You've got two sort of customers, really, haven't you? You talk to your customers.
Look, the customers, we break it up into two major customers. So we've got borrowers who have a need for finance.
And what kind of people are they?
So they're people that might. We tend not to do construction. So our customers are people that have a complex structure. Banks can't get their heads around that complex structure. They may have a commercial asset or an industrial asset or a block of units that need money in a quick fashion and efficient fashion, that have a short-term needs. They might need the money for 6 months. They might need the money for 12 months. So major banks, for argument's sake, would stay away from shorter-term business because they want the capital for a 30-year term. Well, we are okay with doing shorter tenure, but we will not do any specialised assets. So our borrowers We won't lend to bowling alleys, pubs, clubs, service stations. We are a vanilla business. We like things that we can drive past, that we know if the unlikely event we need to recover the money, that we can sell it quickly and we can sell it to the general public. So I think that's from one of our customers being the borrower side.
Yeah.
Now, in our investor side is diverse. We've got a lot of self-funded retirees that have a need to put their super fund money somewhere to get a return, a reliable income stream on a monthly basis. We've got high net worth individuals that have excess amounts of capital that need to run it.
Right.
So we've got a diverse investor pool and a diverse borrower.
Yeah. All right. Now, if someone put their money with your investment, what is their protection? What is the main protection that they've got?
Look, I think the underlying security is the first aspect. So
What the money's been lent for.
What the money's been lent for. So we've seen in recent past investors giving money to and not understanding what the underlying security is. We've got a mantra in our business. You need to understand what you're doing and what the money's being used for. For us, we've got a borrower that needs money, secured via property. So every one of our investments is secured by a property. But I think another...
But what does that mean? Secure, but people hearing that, what does that mean?
What does that mean? So we take a mortgage, a first mortgage over a particular property.
A residential property?
Residential, more
Mainly?
so at the moment. We do industrial and we do commercial.
Okay. So I want to open up a hamburger joint, right? And I worked out I'm going to need $1 million to do it, right? Can I go to you and try and borrow $1 million and I've got a house worth $10 million and I'll put a mortgage up? Is that
that is one aspect of it. What we won't do is lend to the hamburger business without having a property to secure that money on.
Yeah.
So that is the aspect. So we see people lending money to companies and taking no security other than that company. We see huge risk in
that
that.
company could be dodgy or could just fail.
Well,
hospitality industry with the coronavirus.
We've seen issues with COVID. I mean, Paul Miron loves talking about the zombie companies. He's the other managing director in our business.
Yeah.
But their care has to be taken when you're lending to a business.
Yeah.
And
so the bottom line is that someone who borrows from you has to basically put up his or her property as security.
Yes,
and they then can borrow how much off the value of that property?
Typically, we don't lend more than 65% of the value. I think care has to be taken. It's not just you own a family house. It might be a commercial property. It might be an industrial property.
But you'd see it as something that's easy to sell.
Correct. And we generally lend no more than 65%, and we typically lend in Sydney. I mean, that's our bread and butter, and that's where our security properties generally are. But we do like Brisbane, and we do like parts of Queensland, and we do like Melbourne as well. At the moment, we're a bit more cautious with Melbourne. We're going to let them open up and see how some of the underlying businesses are going.
Okay.
But we're an Eastern Seaboard lender.
All right. So what does the borrower generally pay as interest, and what does the lender to you get?
Well, look, in the recent past, we've seen a compression of investor returns. So we're still offering lender rates of give or take 7% to our net returns to our investors. That would, in COVID, you got a COVID premium. So anyone that was backing lending in the COVID environment were getting a lot more than the 7% net returns. So I think it's important not just to look at the return, look at where you're lending, who you're lending to. I think in this market where the cash rate is so low, the compression of returns are going to happen. It's going to happen a little bit faster than we think. But what we are seeing are low returns masked with high risk. So we always tell people, understand what your risk is. Just because you're getting 4% doesn't mean it's a non-risky investment.
Anything over 1% is risky, isn't it, really, when you think about it nowadays?
Well, that's right. Yeah. So you need to be careful.
Yeah. And so, all right, so you talk about a contributory structure. Most people wouldn't understand what that means. What's that mean?
I know you always pick me up on that, Peter, but
contributory,
I know.
I don't understand.
The contributory structure is a structure that we actually really like, in that you can choose the investment that you want, and you've only got exposure to that particular investment.
All right. So if I give you my $1 million and you're going to put it into that particular property over there, I can see where it is.
I'll even give you a different example. If you had if I provided Peter Switzer an opportunity to invest in a property in Lilyfield at 60% loan to value ratio, so 60% of that value, I will go, Peter, would you like to invest in that particular investment opportunity? If you like it, you say yes. So your exposure is directly attributed to that investment. You're not attributed to another investment in far north Queensland for land. And I think it's important also the disclosures that you get from us when you're actually signing up to investment. So we're an ASIC regulated mortgage fund. You get an investment memorandum which specifies exactly what you're going to get for your particular investment. There's no ifs, buts or maybes on what you're going to get. And I think that is what is important about what a contributory structure does.
Okay. Who's on your board?
Very good question. So we have a gentleman that's very well known in the industry that's our chairman and head of our credit committee by the name of John Thomas. So he's been in the industry for over 40 years. He used to run Howard Mortgages that was then sold to Challenger. He's a grandfather of mortgages. He hasn't lost $1 of investor capital in his life. And he loves saying that, and he tells us every day, and he puts us on a tight leash to make sure that we cover off what we need to cover off. And he's great to have on our board.
Why has a business like yours seen the opportunity to get in the market to attract lenders and to attract potential borrowers?
We'll talk firstly from the investor side, I think. I mean, we're seeing the cash rate being the lowest it's ever been, and we're suggesting that it's going to go down even more on Melbourne Cup Day. If you're holding, and we were talking about it yesterday actually, people that have got money in super and have assets between $500,000 and $2 million have got roughly 23% of their money held in cash. So there's a flow of that capital to do something with it because you're making negative returns when you're taking inflation. So there's a jump up the risk curve for investors needing to get yield. So from an investor standpoint, they are attracted to our asset class because you've got the benefits of property being you're secured against property, but you don't have the negatives in terms of your high costs to get in, you're illiquid. If you need to sell, you've got to maintain it. There's a compression of yields. So we're seeing a flow of capital coming into our sector. So the investors are getting a great return for the risk profile, we believe. On the borrower side, you've got banks who've been caught up with royal commissions that unfortunately are a little bit more clunky in terms of how they do business. You've got people working from home, it's not as efficient. You've got borrowers that need money and they need to find a capital partner. So the non-bank sector has grown and we believe it will continue to grow.
Okay, so is there anything else do you think a person who doesn't know you but is thinking about your business, is there anything else you think they should know?
Look, I think there's one thing that we pride ourselves on, and we go back to COVID. When COVID hit, we treat our investors like it's our money. We called every single one of our investors during COVID to give them a rundown of how their investments are going. I think the care factor, if you can't call your investment manager and ask them how your investments are going and ask about how you made an investment decision, I think that is our core difference, is that we have investors that call us daily. We've got investors that don't want to hear from us. They're happy with the way we go. And I think that's our point of view.
I guess that leads to one last question is that, you brought up COVID. Was there a number of investments that you thought might have been vulnerable because of COVID and you were thinking, I'm glad that we've got a first mortgage security behind that one?
Look, I think the first mortgage security is a powerful instrument. So for us to lose money, even in COVID or anywhere, we've said it before, that the property price would have to drop 30-odd%.
Yeah. The property backing the loan.
Backing the loan. That's number one. Yeah. Number two, we are skewed from a residential standpoint. You ask me all the time, where do you think property is going to go in terms of value? We believe the residential property prices will be resilient, will actually be an uptick in value. Yeah. So from us being a residential, majorly residential, COVID was good to us. If you're heavyweight on commercial at the moment, I think we are going to see cracks. We're seeing cracks now, and that we haven't seen the damage that COVID's caused yet to commercial tenancies, and it's a look and see for the next 3 months, I'd say.
Right, Paul, thanks for joining us.
Thank you very much.
Paul Mialotis, Prom. M Squared Capital.